A historical moment indeed, one that was covered extensively by your channel. But let's shift gears then and move away from that, put the spotlight on the markets then, and discuss more importantly how the global markets shaped up. And for the week gone by, it was a pretty smart rally for the global markets. We gained close to 2.2% on the NASDAQ, and in particular, you did witness pretty smart advances there from the kind of movement that we had witnessed previously in some of those tech-heavy stocks. You had the Dow Jones, the S&P 500, incidentally, which hit fresh all-time highs. And this morning, you've got the outcome of the Bank of Japan's monetary policy. But ahead of that, the rest of Asia as well is looking pretty robust. For our own markets, well, we lost out about 1.5% for the week gone by. And on Saturday's trading day, we wrapped up the day 0.2% lower at 21,571. So just looking at the overall setup, Nikunj, in terms of what the rest of the globe did and what we did for the week gone by, a slight underperformance.
Yeah, see, last week was okay. It was nothing great. It was nothing worrisome. The global cues were just about okay. Indian markets managed to hold on to key support levels. We did get that scare from HDFC Bank, and despite that scare from HDFC Bank, we did not see a very the market in a sense at low levels did find some support. Since we had a Saturday trading session, I would say a market reacted to the Reliance numbers already, and we may not see that kind of a reaction coming in any of the large heavyweights excepting banks, which we'll talk about. So in my book, the market still remains the same, which is that when there is a little bit of profit booking, a mild mean reversion, when markets are threatening to go below the support levels, that's the time you need to buy. The reverse of that is that when markets are showing you a promise to break out from key resistance level, when just you get 2 or 3 days of uptake, if you're a trader, you should start selling. You need to be cognizant that in the mid and small cap space now, there are some pockets of overexcitement, whether it is defense or some PSU names. But in general, I guess markets are not giving you a very strong directional cue. If I look at the price action, well, the price action is more negative than positive. The market reaction to, let's say, a news like Polycab or HDFC Bank, or even for that matter, what happened to some of the companies which have come out with numbers, I think that is very harsh. So we are in a market where bad news is getting punished disproportionately. Good news is getting ignored. Markets so far have managed to find support at lower levels despite FY selling, and the inertia on the upside is clearly getting jammed, so to speak. So I won't use the word listless, but it's a market where for next few days you may just not get anything big on the Nifty, but yeah, stock specific, I think the market reaction has been rather nasty in some case.
Yeah, absolutely. And I think what really marred all through last week was HDFC Bank. I'm sure ICICI Bank is going to make up for some of that, or Kotak did attempt on Saturday itself. But the way HDFC Bank plunged, and I guess there is now that leadership change as well. It's clearly ICICI Bank over HDFC Bank.
So let's look at this graphic, Aisha. I think why is that graphic important? The reason why that graphic is important, because when HDFC Bank numbers came out, and because it's India's largest bank and it has got the biggest book, and when a bank like HDFC Bank in a sense goes through a painful quarter, then is this a sector specific concern, or is this a bank specific concern? This is a sector specific concern. Thankfully, it appears that the concerns what have come out of HDFC Bank, that is more like a company or a bank specific concern. Why? Liability, CASA and NIMS. ICICI Bank has grown, IndusInd Bank has grown, Kotak Bank has grown. So the good news is that the sector per se is not threatening to slow down. And if that is the case, then that automatically means that in the near term, money will gravitate out of HDFC Bank, which is an overowned position, back to other banks. So I will not be surprised post numbers, Kotak Mahindra Bank and ICICI Bank, they start outperforming. I will not be surprised at that lower levels, IndusInd Bank will find some support. So for me, I think this is excellent news, that the problem that HDFC Bank numbers are not a macro risk. It is not a macro banking event. It is very, very specific, and hopefully HDFC Bank should come out of it. The challenge is that since everybody was on the same side of the boat for HDFC Bank, funds and HNI investors, they were in a sense just drowned in HDFC Bank in terms of the position commitment. So the numbers have come as a nasty surprise, but thankfully that is not like a stock, that is not a sector specific concern. So there was a time, I'm using this example again, that Infosys became the benchmark. Infosys would sneeze and IT sector would get a flu. That does not hold true now. All of us thought that if HDFC Bank numbers are bad, and after all it is a big bank, it's a big franchise, it is big in terms of size and reach. If they are slowing down in garnering deposits, the growth will slow down. But look at the numbers. That does not hold true for other banks. So touch wood. That means that other banks are in a much better shape. So if in a better shape in the near term, the interplay between growth and valuation, I think, is something which will not support HDFC Bank. It has been an underperformer. It may remain an underperformer.
Okay, that clearly is HDFC Bank. That was the talking point. But I think the talking point today is going to be Zee Entertainment. The news came out yesterday that Sony Pictures has terminated that mega $10 billion deal with Zee Entertainment, saying that the closing conditions to the merger were not satisfied post the extension given in the timeline as well. And now brokerages, though Zee Entertainment, by the way, is denying all the allegations, saying that there was no breach under the terms of the MCA. But a lot of brokerages across the board have come out with their latest notes, and you can see it on your screens as well. The current rating is either a sell or a reduced rating. They slashed the target price, and more importantly, Nikunj talking about a sharp derating of valuation multiples, largely on the back of the fact that this was one of the key triggers for the valuations growing.
This was the only trigger. And the fact that it's just been yes, no, yes, no, yes, no, I don't know, I think the stock is just going to collapse. It is been an F&O ban. So imagine a stock where there is a lot of yes and no. It was an F&O ban. The positioning of Zee in a sense has been completely one-sided. The merger goes through, and then in the near term, first there would be technical pressure, then there would be compulsions of F&O, and then there would be a real adjustment for the stock per se. Now there is no point in trying to preempt how large or how big the fall in Zee today really could be, because it's anyone's guess. But the fact that you are not going to find buyers coming out in a hurry and buy the Zee stock. There are a lot of concerns in the near term which are real in nature, which will take time before they are addressed. Concern number one, since Zee is a stock which is owned by HNI investors and by institutional investors, what call they are likely to take. More than 50% of Zee stock currently is held between institutional investors. What view they may take, anyone's guess. Second, what will happen? Could there be legal battle and legal proceedings both from the side of Zee and Sony? And could this just be a big drag on the company and its functioning in the court? There could be a case of that. See, operationally, markets were working with an assumption this would have created India's biggest media company, and now the dynamics completely would change for Zee in terms of the future assumptions. So it's a stock which today, needless to say, will be on the wrong side of the trade. It will take some time for the real price discovery to happen, but I don't think this is a stock where you want to buy the bad news. If you see a fall of 25, 30, 40%, you normally see buyers coming out. But in this case, that may not happen. In fact, it would be interesting to see that what collective call institutional investors will take now, considering that the promoter entity, or in this case actually is less than 10% ownership. So this is not bad news. This is terrible news. And I don't think there is going to be a visible light at the end of the tunnel. I think this is going to be a dark, long tunnel, at least for Zee shareholders, for a long time.
Yeah, absolutely. Still a work in progress. There are some reports indicating that perhaps shareholders are looking to even write to the regulator, Nikunj, saying that remove Puneet Goenka, let the merger happen if that really is the only niggling worry from Sony's end.
See, I don't think the merger will come back on the table now. I think it is very difficult to make a case that, Mr. Goenka, minority shareholders, they come to one side and they, in a sense, look at change of guard at the CEO level. The bottom line here is that Zee as a company is owned by institutional investors, more than 60%. What call are they likely to take? That's anyone's guess. B, will there be a shareholder activism which may happen in Zee? I don't know. Legal proceedings from the side of Zee and from the side of Sony, that may actually go through. Zee has failed to make some payments in terms of giving broadcast rights to Disney in them case. Then there's a proposed merger which has been on and which everybody is talking about when it comes to global level between Reliance and Disney. So that also will have its implications in the way how things would move. So it's not a stock where you really want to say that, oh, I'm going to buy the bad news. The reason why you should not go and buy the bad news is because the price discovery will take some time, because the sequence of events, earnings, technical pressure, all that is something which will not be settled in a day or so. And when there are a lot of other options, why just go for blind? I mean, go for seen. That's my limited point.
Yeah, okay. Let's now move across to Vinny, find out what the global commentary has been like. While we were, of course, trading on Saturday, the rest of the world was off. But Vinny, what's the view like? Global opinion?
So absolutely, we have a lot of commentary that is coming. Let's start with the one that is coming from Moody's Investor Services. Now, they are a bit negative. Their outlook is negative for the sovereign credit worthiness of Asia Pacific, mainly because what we are seeing is in terms of the Chinese economy. They're saying the growth has not been there. And that is why that's the concern coming in from Moody's Investor Services, that are concerned around China's growth. And that is why negative outlook even coming in for the Asia Pacific this year specifically. Other than that, Federal Reserve is also on track to actually achieve US soft landing in the US. That's the word that's coming from Goldman Sachs Group Inc. Chief Economist, and that's the word there, that yes, soft landing expected in the US this time. So yes, positive sign at least coming in terms of the commentary here. Other than that, we have even Peter Schiff, who's talking about Bitcoin now. He's highlighting, and his concerns have always been there whenever you see any of his tweets on Bitcoin ETF as well, that the volatility that we've seen in Bitcoin, that will be coming in even in Bitcoin ETF, and maybe likely that investors will lose that money even in Bitcoin ETF. A caution coming in, a word of caution coming in from him even on Bitcoin ETF. And lastly, let's talk about Goolsbee, Federal Reserve Bank Chicago president. He's highlighting that seems like considering an interest rate cut this time around in the month of March, and the policy this time is something that would work out well, because yes, he said that this would keep them from avoiding keeping the policy too tight. So yes, a rate cut may be something that officials should continue and consider in the March interest rate policy cut. So yes, keeping an eye out on that.
All right, thanks very much for those details. Let's connect with our chartists to find out their top recommendations. Kunal and Naresh joining in as always. Kunal, let's get in your take then. What is the outlook on the frontline index given the kind of move that we witnessed on Saturday's trading day? Is it a bit of consolidation or any decisive moves given that 21,600 eluded us?
Good morning. So I think after hopefully the move which the GIFT Nifty is showing, we should be back about 21,700 mark, both in terms of spot as well as in terms of futures. I think that could be a very strong indication that maybe the trends on the upside could re-begin for the indices. So we were waiting for this neckline breakout to happen for the index. When we managed to break above that 21,700 mark, that was a key point of trigger. Even on the way down when we were correcting from 20 to 100 levels for the index, and we managed to fall sharply towards 21,500 and below for the index. So I think if we manage to close above 21,700 mark today, that could be a strong indication that we could be looking at fresh longs on the index as well as a fresh trend building up on the upside.
Okay, there you have it. Let's get in a take then on the Nifty Bank Index. And Naresh, comment on levels that you're tracking on the Nifty Bank.
So earlier 47,000 was the support level, which should now act as a resistance given the breakdown in HDFC Bank. But what is interesting is the fact that we've not seen a similar price action on the downside on numbers from other banks, and that indicates that we could make that recovery back towards 47,000 for now. And once we sustain above 47,000, that would be an indication that momentum has shifted on the Bank Nifty. So for now, expecting a bounce towards that 47,000 mark, so remains a buy on dips. Overall, it's just the heavyweight problem of HDFC Bank not taking any leadership, but the rest of the banking charts look promising. So expecting a slow and steady bounce back here.
Okay, let's nail it down to those individual stock trading recommendations. And both our chartists have got banks on their radar. Which ones do you have, Kunal, as part of your buy list?
So the first one is Bank of Baroda from the PSU banking lot. I think even after the the move which we had seen for the last couple of days in the private sector banking names, Bank of Baroda and many of the other PSU banking names are actually showing signs of strength. So would suggest a buy with a target of 250. Stop loss could be kept at 226. And the second would be a buy on Concor. That's also a stock which is heading towards almost like a V-shaped recovery on the short-term charts. So would suggest a buy with a target of 900, stop loss at 860.
All right, Naresh, let's get in your top trades, and ICICI Bank features on the list.
Yeah, so the stock has finally come out with the numbers, so that event is out, and we've held on to that 1,000 mark, and if it crosses 1,050 today, that would be a breakout confirmation. So out here, buy with a stop loss at 1,000, target price of 1150, looks like the new leader in the banking space. Second is a buy on Lemon Tree, which has given a breakout before and has been trending slowly and steadily up. A little bit of a pause here gives a fresh entry point. Stop loss at 128, target price of 150.
Okay, let's talk some of the other stocks which are going to be in focus this morning. Anisha is here to flag off the same. And Anisha, last week, as extended as it may be, extended was the rally on the railway names, refused to stop.
Oh, I mean, chugging is no longer a word that we should use for them. It's the highest speed rail probably that we are witnessing here. These stocks have surged, what, 80-90% in a matter of few weeks itself. And of course, if you look at a one-year move, these stocks are up anywhere between, 3 to 5 times. That's the kind of big rally that we have seen. And yes, of course, the government's capex has gone up, and there could be that pre-budget momentum which is building up. But I don't know what explains the kind of move that we have seen over the last 1 month, because not that these companies have bagged some huge orders in the month gone by, or there are some big allocations coming their way, at least nothing, and on the anvil as of now. But the market capitalization of these companies has increased multifold in the last few months itself, and the valuations too have become quite punchy. IRCTC, for instance, is sitting at a valuation of 65 times. The company does a business of just booking the tickets and probably some amount of catering, etc. So it's a low margin business, but still it's trading at 65 times. You also have IRFC, which crossed the market capitalization of over 2 lakh crore rupees. It's higher than the likes of M&M, Bajaj Auto, and a lot of nifty companies. The book size isn't that large, but not sure, Nikunj, what Street is factoring in. And is this something which is warranted or completely over enthusiasm at this point of time?
Okay, we are talking about railway stocks, but just remind our viewers that all railway stocks have different businesses. So every business is in a different, cycle, so to speak. So just because it is railways, I think the stock should not qualify to go up or go down. But when there is frenzy, when there is excitement, when there is complete disregard for the underlying business, and so that's what happens in the market. Bull markets are strange things, and markets can just remain irrational for longer than you can remain solvent. So there is no point in trying to preempt that, okay, this is the red line and this is what the stocks will do. And if they go above these levels, it's not going to go further. Market cycle has always told us that strange things can happen. Right now, there is a rising tide phenomenon. But what you can do, you can ask yourself one simple thing, that if I don't sell now and if I buy now, what is the risk reward ratio for me? The risk reward ratio for buying these stocks now, I think, is just not in your side. If you don't intend to sell, well, that's a call which is purely based on the fact that you need to be prepared for the fact that these stocks can just turn. They may not turn for next few days. They may not turn for another 1 month, so to speak. But when the turn is going to happen, trust me, this is a stock where institutional investors are not going to be rescuing you, looking at the valuations and looking at the core fundamentals. So if you own the stocks, if you can fasten your seatbelt and say, okay, I'm going to ride the momentum, I may make another 10%, but I will digest a 15-20% volatility, I'm prepared for a sharp turn, then you should buy them. But frankly, if you're looking at a fresh capital allocation into these stocks, let me assure you, based on my experience, when I've spoken to everybody, there are far better options in the market. Look at RIDA. 35 rupees has become 140 rupees. It absolutely amazes me. It absolutely amazes me. 150 rupees. So it's a 5x in less than 6 months. Issue price was 35. It's become 150. So it's a rising tide phenomenon. For those who are part of it, well, you can enjoy the joyride. But if you think that you can jump in now, well, you're late to the party. The train in this case has literally left the station.
Okay, and you've clearly possibly missed that, so don't try jumping on. That's really a rising tide phenomenon as Nikunj is describing it. But that aside, let's also discuss the new government scheme for rooftop solar projects. Anisha, and which companies stand to benefit?
Well, a whole host of companies actually, right from the people who manufacture the PV cells to the EPC players involved to the financiers as well. The entire ecosystem is likely to see a bit bump up. But let me first bring you up to speed in terms of what the announcement is. So the Prime Minister yesterday, after his Ayodhya visit, has finally launched Pradhan Mantri Suryodaya Yojana, which aims to install rooftop solar systems at 10 million households, or almost 1 crore household. So these are those small, ticket size kind of solar panels which are put up at the rooftops, etc., of houses, and this is likely to happen in the mid-tier towns in northern India and central India as well. Now, in terms of the companies which stand to benefit, well, REC is the one which has been nominated as the agency to take this forward, and they are expecting AUM of almost 40,000 crore to come as far as this project is concerned. Of course, the PV and the solar EPC, operators, the likes of Wari Energies as well as Tata Power stand to gain, because these are the big leading players which people usually go to when they have to put the solar rooftops. And of course, in terms of the entire supply chain, this the PV manufacturers, the likes of Borosil as well as Jas Energy, Tata of course also has the PV capabilities, and even in smaller sets you have Adani Green as well as JSW Energy, who have these smaller capacities. So the entire supply chain is likely to benefit, but the good news is that the demand of the entire PV ecosystem is likely to inch up, and the country is now geared up. So earlier there were these questions, Nikunj, whether we have the enough capacity to deal with it or not, but we now have a very clear pipeline of that as well.
See, I look at the big picture very simple. India is deficit in hydrocarbon. We import hydrocarbon, but we have abundant sunlight, and sunlight is for free. There's no inflation there. So in terms of a very basic, big picture argument, India energy needs are high. India is abundant on sunlight. The solar, the cost of installation is down by about 90% in last 10 years. The cost of producing solar power per unit, which was at 15 rupees, has now come down to 3.5 rupees a unit. And now imagine if your energy needs are going to be higher, looking at how the Gujarat model has worked, how the change in a sense is actually getting migrated. Here in Mumbai, I was looking at, I think it is CCI, which actually has a solar rooftop. So it actually is successful. Now, what this means, like Anisha said, she just brilliantly looked at when a large change happens, and when that large change happens, the entire supply chain actually tends to benefit. But who would really be making solar power? I think in this case, there are very few players. The largest, I think, there would be Wari, and I think it is Tata Power. They are the ones who will get disproportionate beneficiary. I don't think, Anisha, this is a space where a lot of EPC companies would benefit, because these are not large solar installations. These are rooftop installations, which in a sense would be done by the company themselves. So these are not large commercial installations. But then apart from that, one more sector which would gain, I think, would be the single meters. Because when you generate power, you would meter them, the meter would connect you to grid, they would benefit. Then the third big beneficiary in this case would be that when you generate solar power, how do you put it back through the grid? Through the wire. So companies which essentially are in high density wires, they also would be disproportionate beneficiary. So this is something which is long awaited. This is something which successfully can be implemented, and from a stock market standpoint, it is just going to kickstart a new action in some of the so-called solar panel manufacturer stroke that entire supply chain.
Okay, there you have it. Those are all the beneficiaries. Thanks so much for joining in, Anisha, and giving us that heads up. Here's what's lined up ahead on the show. We'll be discussing this topic and lots more. Stay tuned. After this quick break, we'll be right back.
Back with the market right here in ET now, and as elongated last week was, this one is going to be an acutely truncated one with just 3 trading days. With yesterday already was enough, and so would be Friday. But let's welcome on board Sanjeev Bhasin and find out what these 3 trading sessions are going to mean for the markets. Sanjeev, hi, good morning. Last week was, of course, marred by HDFC Bank, but seems like ICICI Bank is going to pick up the flavor for banks.
Yeah, good morning, Aisha. Welcome to the biggest event of Jai Shri Ram, and now looking forward to 26 January. Also, not to forgot to mention the Dow crossing 38,000. The pessimists and the people on the sideline waiting for corrections and talking of overvaluation, all that is on the sideline. The mid-cap index hit an all-time high. REC, PFC, NBCC, GAIL, you name the stock, IREDA. Look at the earnings and look at the numbers. So they are expensive, but it's expensive because there is no ownership. I was very flattered by the numbers of Colgate. I think Colgate, and I've been repeatedly telling you from 1800, Colgate is going to be the star for the FMCG. Now you watch Nestle's numbers. So I still think that now there are enough wheels to add to new highs. And I would be more bullish on the bank nifty, given that the PSU pack on earnings along with ICICI have been stellar. So I think the underperformance of HDFC now gets neutralized. By the way, almost 25,000 crore worth of HDFC stock has been sold. Now, whether it's a discount of 10% or no, who knows that you could see an expiry closer to 1600 on HDFC itself, given that most of the carnage is in. So extremely positive for the next 3 days and beyond. But let's watch for 21,850 being crossed and all the bears coming for covering.
Absolutely. Let's see. And let's keep our fingers crossed. Hope all the damage is already done on HDFC Bank. And maybe ICICI Bank and Kotak, which already did the magic on Saturday, it can pull us up through further. But here's what the managements of Kotak as well as ICICI Bank had to flag off after their earnings came by.
If you look at the growth of unsecured, we have talked about the fact that we are quite comfortable to grow this. If you notice, we had come down on the unsecured retail during the COVID period, and thereafter, we've been steadily increasing. We are currently at 11.6% of the overall advances, the net advances. We've said that we would be okay to take it to early to mid-teens, and we are on that trajectory. At this stage, there is no intent of kind of trying to put a break on that.
So our focus has been really as to how do we grow our overall deposits. And our CASA ratio, what you talked about, is still amongst the highest in the industry. The system liquidity is extremely tight. And if you look at where the market trades overnight are trading, are actually above the repo rate. So as far as we are concerned, we are very clear. Our focus on granular deposits through active money, through term deposits, through CA and SA. So we have 3 different strategies on the savings. If you look at the stress, it's still stable, manageable, and we continue to grow the business in line with our strategy.
Rural business is cyclical, and there are peaks in the December quarter and in the December quarter. So if the increase is primarily in account of seasonal NPA additions in the Kisan Credit Card portfolio and some amount of normalization of NPAs on the retail side, overall, I think if you will see the overall NPA provision numbers, they are very comfortable. No, the capital adequacy is, there's a marginal dip, which is not the numbers that you talked about. We have a capital adequacy of 16.03%, and that includes profits for the 9M against the 16.7%. As you are aware, RBI, changed the norms relating to certain segments of our assets, and this sort of largely reflects that.
All right, that's banks, but Sanjeev, dare I talk about the big newsmaker, Zee Entertainment? After all the flip-flop, it looks like there's been a crash landing. The merger has been completely called off, and all the brokerages are warning that there's going to be nothing short of a free fall now for Zee Entertainment valuations. And question is, what's going to happen now?
Yeah, unfortunately, this was coming and you had to be geared up. But let me tell you, 61% of Z is owned by mutual funds and LIC. So how can you have the largest shareholders do nothing? And now there are question marks on those independent shareholders, board of directors who did nothing for 3 years. So I think the Goenkas will be shunted out, and that would be the best case of, consumer investor activism which you are seeing. I am very, very optimistic that there will be as a disclosure, you are aware, Mukesh Ambani had put in a bid only to be second to Sony. And I think now there will be another buyer. The underlying business remains very robust. Yes, the uncanny thing of Sony calling it off. We'll see a lot of court battles, but we'll wait for that to be played out.
Your dog who's disturbing us right now, Sanjeev?
Huh?
I said, is that a dog nearby you?
Yeah, that's my third son called
Oh.
Shiro. So he's playing little spoil sport. Sorry for that.
No worries at all. Maybe we'll get more TRPs if we have him on air. But that aside, I wanted to get your thoughts on the railway stocks, because we were just discussing this a short while ago and looking at the mammoth move as well that we've witnessed in some of these rail stocks. Is it advisable to jump on, or have you missed the train completely?
Awan, that's what I'm saying. The stock market is a glass half full, half empty. Don't look at the HDFC Bank of the world. Look at the broader market. NBCC, the rail stocks, REC, PFC, the list of PSUs hitting new highs is endless. Union Bank numbers, IREDA numbers. That is where the money is being made. And unfortunately, that class was missing for mutual funds. And some of the, large PMS who said PSUs are untouchable, and so are technology stock. Look at the earnings from Persistent. Look at the earnings from Coforge. Not to forget SW Solar. It's been hitting 3 circuits, and for the right reason. As you just pointed out, 1 crore solar panels to be installed. SW Solar is the lowest cost producer, MEP player, mechanical engineering and plumbing, and it will be laughing its way. So I still think there is a huge under ownership of PSUs that will be gather steam. As a disclosure, we have IRCON and IRFC both in our portfolios, but please do not chase them. But replace some of your real estate stocks with large cap banks. I think ICICI Bank is going to see a 30% jump in market cap over the next 3 to 6 months.
Well, you said real estate. Curious to know, Sanjeev, any fresh ideas within the realty pack or any beneficiaries?
No, like I've been warning you, stay away from real estate. I think they're fully priced. I would rather go on a quasi play. So I've been saying banks, and I've been saying, I think small banks which trade less than 1 time price to book, particularly in the space of, part PSU, part private, like a Dhanlakshmi Bank, which we've identified as a disclosure that is in our personal portfolio in our client. That could be these could be stocks which can double. They have no large ownership. They are less than 1.5, 2 times in ownership by any percentage, and they have huge outflow as far as the business is going. Whether it's gold loan, agri loan, it's one of the best banks from Kerala. And the similar case was with RBL when there was no promoter more than 2%, closer to 100 rupees, and you had the Mahindra's buys. So I am very optimistic on that. I was very impressed with Colgate earnings. Indus Tower is my dark horse, which I've been telling you. That will be a big outperformer. Look for targets closer to 300 on Indus Tower.
Okay, thanks so much for taking time out and joining in. Let's in fact connect with Boman Rustam Irani, CMD at Keystone Realtors, to talk a little bit more about the redevelopment projects that they've bagged and lots more. Thanks much for taking time out. Let's just understand a little bit more about the recent announcement and what the outlook is when it comes to the development pipeline for the company. What is it that you're expecting to end the year with, Boman?
So good morning, everybody, and thank you for having me on your show. I'd like to just state that we are in line with our guidance of project acquisitions, and we've more than doubled the acquisition for this year over last year. Last year, we had about 3,425 crores. This year, we've already crossed about 7,050 crores. And this is in line with in line with our guidance of low cost of acquisitions or low entry cost, asset-light models. Most of the redevelopments that we kind of go for come to us, and we are continually focused on continuing our strength in the western suburbs. And as you can see, the acquisitions, last 3 acquisitions that we've had in this quarter are all in the western suburbs itself. And the very fact that these redevelopments continue to come to us speak of our strong trust that the consumer has and the redevelopment or original flat owners have in the Rustomjee brand. And we plan to continue with this. in all areas where infrastructure growth is taking place, as we are aware. The Sea Link and now the Coastal Road is all a reality. Work is on in full swing. So Bandra and the western suburbs will continue to grow.
So just taking it off from what you were just talking about, the redevelopment projects that you're now getting into, one in Malad, a JV, as we understand, with the Ajmera group as well. What are the kind of offerings and what price points are these redevelopment projects going to be?
So very good question. First of all, wherever Rustomji goes, it is only in line with where we can add value to the development. And that's how our tie-up with Ajmera, which is a prime property in Bandra West, where we believe that we can add value in terms of design as well as execution and sales. Malad continues to be a very strong growth area, and that's where we've acquired about 12,000 square meters under redevelopment, two separate societies. And over here, we believe that the price points would be in the region of about 35,000 rupees on carpet area. And Bandra would be in the region of about 65,000 rupees on carpet area. So these are the price points that we are there. And hopefully, these are the price points that we will be able to better as we go along with our developments.
There is a general view in the market that the base effect for the real estate sector would kick in. Supply is going to be disproportionately higher than what the demand is, and given that the nature of the island city of Bombay is changing because of infrastructure development, we actually would see a lot changing in terms of what the buyer would be buying and what he should be focusing on.
So Nikunj, let's put it this way, that every launch does not see the light of day in terms of completion. So that is one thing that we've always had as a factor to concern ourselves about redevelopments or about developments in general. And that's why a lot of more focus or a lot of more customer buy-in is taking place into branded developments. And again, one has to be choosy about the kind of developments that one will go with. So while there's a lot of growth taking place, infrastructure-backed growth is what we are consistently following. That is to say, wherever infrastructure growth takes place, whether it is by way of metros, whether it is by way of new roads, whether it is by way of new developments of commercial taking place in a particular location, where then residential automatically becomes an automatic choice for people to go in, is what we are doing. And as you've seen, Nikunj, we've always kept an asset-light model, and this has helped us even kind of hedge any kind of a downside risk that may be there. But once again, I'm not so concerned about the quantity of development because Mumbai as a market itself is growing phenomenally. And we are at an all-time low of ready inventory in the markets as of right now, which itself speaks to the strength of this market. And to credit the developers, we've kept the prices under control in spite of inflationary pressures on all prices going up, whether the materials that we buy or the charges that we pay to the various government agencies. We've managed to keep our prices under control, and we've kept volume as the premium that we kind of want to work with. That is, I'm speaking of all the larger developers. And I see this continuing growing. I'd like to just point out to a few reports that have come out from CREDAI, where CRE Matrix and other agencies have been involved. And we've seen that there's a strong, healthy growth predicted for the MMR market going forward for at least the next 2 or 3 years in the visible timelines.
And I just wanted to ask, are there any expectations that the real estate sector is going in with when it comes to the budget, any wish list?
So first of all, I'd like to state that there's a big property exhibition coming up in Mumbai on the 26th, 27th, and 28th at the Geo Mall, and I'd encourage your viewers to come. And when Lord Ram has also gone home, it is time that we all find a home of our choice. Then further, we'd like to state that with this budget, we've had only 2 or 3 asks, and they're all for the consumer. One of them has been that GST should be rationalized. We should be allowed the input tax credit as a choice. If the government wishes, they can give both the choices available to the developer when the developer is starting work. Then secondly, we've asked for a tax break for our consumers who are taking loans, and these loans should cut, the value of the tax break should be going up. It's way too low, especially for markets where prices are going up. And third is the definition of the affordable housing, which has been at 45 lakh rupees for the last 5 years, even by general inflation, is up to about 70 lakh rupees. So if the affordable housing can be disconnected from the price and only kept as an area, that is 60 square meters and 90 square meters or thereabouts being the affordable housing definition, it will allow a lot more liquidity to come into the business and also allow developers to reduce the prices and increase the volume of the transactions taking place, thereby providing a home for all, which was our Honorable Prime Minister's vision. And he wanted it done by 2022, but we will get there. And by 2030, we've got about 60% of our population coming into the metros. So metros need to develop, and 45 lakhs is not a number that one can provide good homes at. So that's our ask from the budget.
Your time. Thank you for joining in and sharing with us a view on Keystone Realtors as well as what the outlook is for the sector. All right, meantime, let's get a chart check going as well. And Naresh, come in on Zee Entertainment. Given the news that has now transpired yesterday, what's in store for the stock?
So 2 years have gone by and we keep flipping from the bottom of the say range to the topmost of the range. So for now, for the last 1 year, 290, 300 was the range, and the lower side has been 180 to 190. And mind you, this is the price point where it all started 2 years back. So I would expect that 180, 190 remains a major support. So that's the price point I would be watching out for a recovery from, which is where it all started 2 years back. From there, the stock had gone to 300, 360 levels. In the short term, it broke below those 230 levels, which was a support 230, 240 for the last 3-4 months. So technically weak, we could be going testing closer to that 190 mark.
Right. Meantime, Kunal, a quick check-in on those railway stocks, Aircon, Rail Vikas Nigam, etc.
See, I think the run-up in the last few days have, of course, intensified a lot. In fact, on Friday, rather on that Saturday session, we saw only many of the railway stocks moving up by double-digit percentage for themselves. So, there is some sort of a zone of euphoria or an overbought nature which is coming into these names. So, of course, buying these stocks at current levels would definitely not be advisable, because of the way the risk reward is skewed. Even if a risk reward of 1:2 is generally considered as a good risk reward, but in these cases it's now less than 1:1 for many of the stocks, because of the way the stocks have panned out and the charts have panned out over the last few weeks. So I think buying these stocks could be a lot more riskier than what was earlier. You'll have to wait out for a sizable correction for these stocks, and by sizable I mean at least a 20% odd, 25% odd correction into these names could offer a good buying opportunity.
Chakri Lopriya as well joining in on the show. Chakri, hi, good to have you on board. Let's get in a take then first up from you as to how you've read into Kotak's earnings as well as ICICI Bank and what you make of the stocks post the quarterly numbers.
ICICI numbers were clearly better than Kotak's, and their loan growth and the deposit growth has kind of matched out, so that I think their impact on their NIMs or their margins will be better than what the impact will be on Kotak. And both of them trade at about 2.5, 2.7, 2.8 times earnings. And for there will be some kind of a NIM moderation at this point in the cycle. And given that, Kotak has had a slightly increase in provisions, and therefore I think it'll kind of tread water at the current levels, whereas ICICI will probably do better from the current price.
So can we say that the challenge for HDFC Bank is more like a bank-specific challenge? It is not a sector-specific challenge?
Indeed, absolutely. Because, if you look at ICICI today, earnings, their loan growth at 17, 18%, deposit growth at similar numbers. And also, if you look at the numbers reported both by PSU as well as PSU banks, of course, their loan growth there, some of the banks is far stronger. So it's indicating that the system itself is growing. And here, clearly, in the case of HDFC Bank, they're having this merger integration in terms of matching the book. On one hand, you had HDFC, the mortgage company, and then the bank, and with very different margin profiles. Getting them together, I think, is resulting in both cost of funds problem as well as in a growth problem.
Fair enough. That's the view coming in. Meantime, let's get in your take then, Chakri, as to what the outlook is on Z Entertainment, now that the massive merger has been called off, does it spell only bad news for the stock going down the line?
I think it's best that we stay on the sidelines on Z because clearly with the merger now being called off, there's going to be a lot of management bandwidth which is not going to be on the business but in trying to fix what they can salvage, and therefore growths etc. will come down. And in a competitive business in the media industry, in a super competitive business, I think this spells bad news for Z. And I think you'll see a whole lot of of course, the stock is likely to open weaker today, and stay weaker for quite some time.
Have it. That's the view coming in. Meantime, just checking in on some of the other movers on Saturday's trading day within the Nifty 100, and you had names like a Coal India which were active in trade, United Spirits as well rallied, Petronet LNG gaining, along with of course the likes of some of the Adani Group stocks and NHPC. Kunal, let's just get in a take. Any of the stocks that I've mentioned looking good for a further up move on the charts?
Yeah, I think NHPC is something which looks interesting out of the lot. I think that's a stock which has done reasonably well. Moved up. I think from a level of 30 to 40 initially towards now in breaking past about the previous major swing highs. In fact, many of the other PSU names like NHPC I think have also done reasonably well for themselves. So I would probably believe that this is the start of a strong zone of momentum, a breakout of that 40-45 mark earlier, and then a stable uptrend which has come back into the stock indicates that this is a trend in the making from a medium to long term play. Now it's very difficult to try and put a target for these kind of stocks because these stocks they generally get into a strong multi-year uptrend. So I think it's the best strategy over here is to have a trailing stop loss which could be significantly placed I think at 65, 66 levels odd for NHPC, and the moment the stock keeps on moving up higher by a margin of 10% to 15%, trailing stop losses also have to move up higher.
Chakri, just looking at what has been happening within the railway stocks, right? I mean, just looking at the kind of valuations that some of these stocks are quoting, it's higher than a lot of Nifty 50 names as well put together. I mean, it's obvious that new investors need not jump in right now. But what about those who are already making like 3x, 5x of their investment corpus? Should they be also profit taking?
We were fortunate enough to get in onto this bandwagon more than a year ago. So we are not selling at this current levels because, yes, they are expensive. Yes, there will be a correction. But if you've had the kind of upside that you've had, then you can afford to lose, let's say, 15-20% of the top. So that's one way to look at it if you're already a holder. Because, now, if you take a company like, let's say, IRFC, after all the run-up, still, if you look at it on an FY26 basis, the valuations are still only in probably about 22 times. Now, then one can debate about the margins and the multiple that you can assign. So clearly not the time to get in, but if you're a holder of the stock, I think we would still hold on.
Okay, fair enough. That's the view coming in. Hold on to the railway stocks. But let's connect with Abneesh Roy, then Executive Director, Nuvama Institutional Equities. He tracks Z Entertainment very closely to understand now what the road ahead is for the company, given that the mega media merger has been called off. And we're going to start off, Abneesh, morning by reading the header to your note, which says a painful end to an overstretched drama. Given that now the merger has been terminated, what do you believe, A, are the potential reasons, and B, the road ahead?
Thanks, and definitely this stock will be under huge pressure today. There have been a lot of downgrades. We also downgraded. It was a 0-1 event. So three key things. Definitely we see this stock testing below 200 in the near term because it goes back to the pre-merger kind of valuation, which was around 12-13 times PE multiple. And second is there is an uncertainty in terms of the legal cases because Sony and Z both have filed legal case and that will be heard in the Singapore courts. So there is a bit of uncertainty on that. And near-term results also will not be great. Q3, the results we have already put out in terms of preview. So there will be margin pressure and OTT losses. Now coming to reasons, in our view, Puneet being the MD and CEO was not the main issue. In our view, it was basically 2 years time frame had happened. The industry dynamics is changing because this Viacom and Disney Star are looking at a deal. Post that, what will happen? Their combined market share will become almost 35% plus. And Sony is hardly 7-8% market share. So Sony has become very small. So maybe Sony headquarters thought that with such a small market share, and even if they combine with Z, so 7% plus 16%, which is Z's market share, it becomes around 23% market share versus Viacom plus Disney Star at 35% plus. Plus the IPL rights, sports rights, etc. very strongly resides with Viacom and Disney Star. So that could be the reason. Second, of course, in our view, there is a gap in decision-making in Sony, given their decision-making happens from US and Japan offices. In the past, we have also seen that IPO and some of the other merger with Sony India was planning did not go through. So basically, India business for Sony is very small. It's a few decimal points. So that is why the 2-year time frame, etc., definitely was very long. And then they realized that the industry is becoming tougher. In our view, the Russia issue or the Puneet issue, those were very minor issues, and Puneet anyway was willing to forfeit and go and not be as the MD and CEO. So in our view, that was not the thing. So near term, it's negative for both companies. In our view, Z is an attractive option for any strategic or a financial investor from medium long term, given it is the second largest media company of India, which is a growing market. So net near term pain will be there, but uncertainty is there. So anyone who wants to buy the stock after today's sharp fall or the near term sharp fall has to live through the uncertainty of the legal issues, which I said, $90 million of the Sony in the Singapore court. Second, of course, is what happens in terms of the minority stakeholders. Obviously, they'll be very disappointed with the turn of the events because 2 years they have waited, and then finally, when all approvals have come, the deal doesn't go through. So what do minority shareholders do? In our view, they will be looking at some kind of a change. We would need to see what is the uncertainty on that. So these are the reasons anyone looking to buy today has to buy from 1 to 2 years. There is going to be volatility in terms of news flow, plus there will be a lot of uncertainty also. But medium long term, this is an attractive asset for strategic financial investor. So the current valuations will be low because of the uncertainty, but long term things could improve if they can really get a tie-up. Why do they need a tie-up? They need a tie-up for the OTT and the sports business. Otherwise, if you see, it's almost like a 350 crore net cash company. And for the entertainment business, they are quite sorted. But yes, for the OTT and for the sports, they do need investment, which a financial or strategic investor can provide. So that's how it will pan out.
But, Abneesh, the biggest issue, prima facie, also seemed to be the issue of appointment of Puneet Goenka. What happens that? Because it seems that it's pretty much a no-go there. It seems like minority shareholders are already looking to approach the regulator now to have him ousted so that the merger at least has a fair chance of going through peacefully, if at all that would be the case.
So there are two things. One is this merger, I don't think Puneet being the MD and CEO or not was the main issue. That he has clarified also in the BSE filing yesterday. And if you see earlier also, when the SEBI's ongoing investigation was happening, Puneet had said again and again that he being there or not there, the merger has to happen. So in the worst case scenario, he had already told to Sony that you can look for another MD and CEO. That is our understanding. Now, coming to your second part, in terms of minority shareholders, yes, at a 4% kind of a shareholding in the company, it's a very low shareholding for a promoter. So yes, the minority shareholders would look to definitely take some action. We'll need to wait what they do in terms of the board, what they want to do in terms of bringing any probable partner. Those things they would like to evaluate, right? Because 2 years the merger did not happen, and so it's a 4% kind of a holding. the promoters have a very low holding. So yes, minority shareholders would like to do, but we also need to see whether they are very fragmented, whether they can act together. Those issues can also happen. So that's another bit of uncertainty which is also going to be there. So how the concerted action happens or not, that we would need to see in terms of the board and in terms of the partner and in terms of the CEO. So those are the things the market will be waiting in terms of development.
Have you on board. Thanks very much, Abneesh, for explaining to us your assessment of the merger being called off between Zee and Sony. All right, let's move right on. And the pre-open rates coming in on your screens right now. And as we speak, it's up 1% for the frontline indices, 21,781 on the pre-open rates. Chakri, let's get right back to our discussion and wanted to get in your thoughts then as to what the outlook is on L&T. An interesting note from Morgan Stanley today talking about infrastructure margins that will grow, international hydrocarbon contribution and core earnings really growing further after the mammoth move that we've witnessed. What's your view on L&T?
L&T is very firmly well positioned as a stock, as a company. I think after a long time, both its offshore as well as its domestic business are doing really well. And the expectations of the order book will grow only faster. So against this, the margins will improve given that it has some amount of leverage in its balance sheet, operating leverage in its balance sheet. So against this backdrop, as large orders come out, L&T will be the first protocol. I think L&T continues to do well even from current levels.
And finally, let's get in a word from you then as to what the outlook is when it comes to mid-caps, Chakri. Any top recommendations in light of even the budget?
With yesterday's announcement of the solar, I think two companies, one is, of course, Sterling Wilson will benefit from the rollout of solar rooftops panels. Second is also REC, while it's already run up and all that good stuff. Valuation is still on its side. It's going to be one of the lead financiers. It trades at about 1.2 times book. I think that's also will do well at current levels.
Taken on that note, Chakri, we let you go. Appreciate you making time and speaking with us. But time now to take the mid-cap bets from our technical experts. Kunal, you go first. Which are the top mid-cap ideas?
So I'll bet on Petronet. That's a stock which on Saturday's session showed signs of a very good recovery. It managed to close almost at the high point of the day on Saturday itself. So I would expect a strong follow-through up move. Buy with a target of 265, stop loss at 243.
Right. Naresh, what about your mid-cap strategies?
So that would be a buy on Care Ratings with a stop loss at 950 and a target price of 1100 plus. The stock made a new 52-week high, was consolidating for the last 3-4 months, a triangle formation breakout, decent enough volumes on a Saturday. The stock has pulled back during the day, but looks like a good risk-reward entry point at current levels. So expecting a fresh move on the stock in the short term.
So those are the top mid-cap ideas coming in from our technical experts. But let's run you through the headlines across the globe. At least 7 people were killed in a shooting at different locations near Chicago, India, United States by a man who authorities say knew the victims. The shooting took place in Illinois and the suspect is currently on the run. Police said the investigation is underway and hunt for the accused is still going on. More news coming in from across the globe. The US and UK carried out additional strikes against the Houthi targets in Yemen on Monday, marking the 8th round of attacks by the US military on the rebel infrastructure in just over 10 days. The attacks have targeted the Houthis' one-way attack drones, anti-ship ballistic missiles, anti-ship cruise missiles, and more as the US has tried to disrupt the group's ability to fire on the international shipping lines, which they have been disrupting in the Red Sea.
Meantime, strong tremors were felt in the Delhi NCR region after an earthquake of 7.2 magnitude on the Richter scale struck China's southern region last night. The Chinese media reported 14 aftershocks following the primary earthquake, 2 of which measured above a magnitude of 5. Meantime, no immediate respite on the cards as North India continues to shiver due to the severe cold wave. As per the IMD, the cold conditions will continue for the next 4 to 5 days in parts of northern India. It also issued a yellow alert in Delhi NCR, and several flights as well as trains continue to remain delayed due to the thick blanket of fog near Delhi NCR.